Welcome back to Ask the Lender. How do you help clients confidently find the right price point for their home?
When we're working with a client, one of the things that we do is it's a full-blown purchase analysis. So we're going to analyze three aspects that every borrower, when buying a home, should definitely ask and get true numbers. Let's run the numbers. That's all this is being able to let the numbers tell us the direction that, may be best served. So with that in mind, the three main elements, right? We're going to look at a loan comparison. So we're going to look at different loan options, right? The cost of waiting, to your point, we definitely jump into that. And then even the buy versus rent. Does it make sense either way? And as we go through that and gather that information, the numbers will tell all of us what, is the best financial position to be in, whether it is to buy now or not buy, which is totally fine. I mean, either way, we would rather have a client completely make that great decision based on great information. And this is the way to deliver that in a simple format and make sure that they can wrap their heads around it and ask questions for sure. So let's dive in the loan comparison. We'll start with that. So there's three different options in the loan comparison that I typically look at, but as you know, we build this out specifically for each individual client and the direction that they would like to see. So we can build this out, 6 ways from Sunday. It's not a problem. But on a high level, let's just start with the three main ways to look. The first option there is list price. Then there's a price drop in option 2, which is very typical in today's market. A lot of clients will be thinking about, well, I'll just get a lower price, which again, good thing to think of. And the third option, as I say, it's where the rubber meets the road. It's where we're going to look at, do we hold price, but we still take what was going to be a price drop. We turn that into what we call flex cash. And then we use that to make the home monthly payment lower, which is more affordable during that time. So you can see in this case, we're looking at a purchase price of $389. Then we go to $379. And then on that third option, we're going to hold that price at $389. Then we come down here. We're going to look at a couple different ways to do that. The main way there is that FHA loan on the first two. That price point at $389 in this case fits that perfectly. First-time home buyer, it's kind of my thinking in this. But again, we can personalize this for each and individual client. Doesn't mean that this is the way we always do it.
Definitely.
And on the third option there, you'll see it's an FHA with something. It's called a 2-1 buy down. I love terminology and acronyms in any industry, especially mine. It's really simple. We're going to take the market rate. And at this point, it's 6.25. That's what we're using. And we're going to lower the market rate in that first year by 2 points. So that first year interest rate is 4.25. The second year, it's 1 point. So it goes to 5.25. And finally, in the third year, it gets to 6.25.
Very helpful in those 2 years.
It is. Absolutely. Gives you a chance to breathe a little bit and get more and more comfortable with the payment for sure. Because you can see here in option 1, that very first year, that monthly payment, $34.13. And that's including taxes and insurance, mortgage insurance, everything there. The biggest thing is, we would all think that $10,000 in a price drop would really drop the monthly payment, but it only drops it to $33.30 compared to $34.13. So really not that exciting for $10,000, which is a lot of money. What we don't realize, because the loan is amortized over 30 years, that $10,000 is a 30-year amortization. So it just doesn't have the impact. Now, if it was amortized for 5 years, yeah, that would have a much greater impact. So, that's usually one of the first moments where folks are like, oh man, I had no idea. You wouldn't know. You're not expected to know. And that's why something as simple as this allows them to see it just like that, real quick. The one there on the end, the third with the flex cash, we can drop that payment down to $29.40 for that first year compared to the $34.13. So that really has an impact for sure. That's going to really allow someone to get comfortable right away and probably not so far off of rent, if you will, to be able to actually own their own home. That's what it looks like right there.
Okay, so for the first year is 2,940, second year 3,170, and then the rest of the time it matches what the regular loan of the first column is.
Yes.
Okay.
And then the closing costs in this particular scenario, right at about 28,000 for the first two, and then it drops to about 27,000 there on the third one. So we're using the majority of that flex cash in this situation to do that 2-1 buy down and offset that monthly payment. And that 2-1 buy down, by the way, is paid for by the seller. So it is not a cost that is put on to the buyer at all. So again, we can make these numbers specifically for the needs and wants of what a client would be looking at. But at least this gives you an idea of what you could expect to see.
Thanks, Craig, for joining me on this series and sharing about finding the right price point when starting a home search. Looking forward to sharing more to help future homebuyers start their home buying journey with confidence. If you're looking to start your real estate journey, reach out and let's make your dream home a reality.